Hey, my name's Jason Nicholson. Good news, the Bank of England cut rates as we predicted, which is really, really positive for those people that have a mortgage rate. Now, in this video, I'm going to talk about the impact that has, how much they cut, what was the vote on that. There was a real surprise in that, which might indicate where rates are going next, what the expectations are for inflation. They're actually better than they were last month, and lots more. So if you're new around here and you haven't done already, do make sure you subscribe to the channel over there and hit that bell notification. We're on the way to 42,000 subscribers, and the value you'll get off this is the latest property news, house price news, and all of that stuff. And let's make sure the word gets out on this video so people know what's going on. How do we do that? Simple. Smash like, tickle like, do something to the like button. That helps with the YouTube algorithm, and I really appreciate everybody that does that. So, it wasn't unexpected, but it was a little bit worrisome yesterday because the Federal Reserve didn't cut rates, and the Bank of England likes to be fairly close to where the Federal Reserve sits. Now, the Federal Reserve outlook isn't looking great, and it's looking like they might pause interest rate cuts for a little while. But the Bank of England have to sometimes act on their own, and they have cut rates, which is wonderful news. So the rate has gone down from 4.5% to 4.25%. So if you're on a tracker rate, pretty much overnight, you're going to get a lower mortgage payment. So that is going to help a lot of people. Also, people that are sitting on variable rate mortgages, which I hope isn't too many of you, because some variable rates, standard variable rates with lenders can be really, really high at the moment. But I know some of you watching might be on a variable rate, and that will impact you as well. So that's good. Not so great for savers. And one of the press questioned the Bank of England, what are they going to do with the fact that when they cut rates, savers pretty much get a downgrade on their savings rate instantly, but mortgages don't always. Obviously trackers do, but a lot of other mortgage products don't necessarily go down so quickly. And Andrew Bailey said it's not anything that we can really control there. That's up to the banks. They run their own business. So savers, it's not so good. You're going to see a lower return. But for mortgage holders, this is possible. Now, interest rates did peak out at 5.5%. And we've now had 4 cuts. So this is the 4th cut, and we're moving in the right direction. Now, the hints are that we will get more cuts going forward, and that's really good as well. That's what we want to see. They never say outright, at the next meeting we're going to cut, but it's implied, and that's important to see how that all pans out. So what was the members' vote? That's really one thing that we like to look at every single month. And so there are 9 members of the monetary policy. So there's always going to be a win on that either way. But this did have a split, and it's interesting to see where their heads are. So 5 members voted for a cut of 0.25%, and that's what we got. So they won out of the 9. 2 members voted to hold, and 2 members voted for a 0.5% cut. So that does have an indication to show us that there is a bit of a split in there. The fact that there's still some people that want to hold, and they probably want to see what plays out with this tariff stuff, and they talked about inflation a lot in the meeting. But the fact that we've also got 2 separate people now that wanted to cut 0.5%, that's good for me. That's what I want to see more of. I want to see more people on that policy that want rates to come down faster. We haven't had that for a long time. So the fact that there is 2 of them that are moving towards, so out of 9, 7 wanted a cut, but 2 wanted a bigger cut than we actually got. Good. That's positive in my eyes. So that's one thing that we want to look at. Now, inflation invariably got talked about a lot. So I've watched the press conference, listened to the questions as well that we had there. And so inflation is brought up again and again and again. And inflation currently sits at 2.6%, but it's going to go up. the expectation is that it will go up, and the expectation is it will now go up to 3.5%. Now, that is good because that's been revised down. Initially, they were saying that inflation would peak at 3.7%. So these revised figures are positive, and quite often the inflation has been lower than their forecast. So that's good, and that means the likelihood of further cuts is improving, and that's what we want to see. So we want to see the inflation going down. Now, what things are they watching in inflation, and should we be keeping an eye on? So these are the things they mentioned. First off is energy prices, and that's the biggest culprit in in inflation going up to 3.5%. That means it's supply side, and it's not anything that you or I are doing wrong by spending too much money or getting too bigger pay rise that's causing the problem. Energy is the biggest problem. Water bills they talked about. While your water bill is not your biggest bill, that is impacting inflation as well. That was mentioned. Next was broadband and mobile phone bills. They're expected to go up at quite big increases over the next few months, higher than inflation as well. And so broadband and mobile phone bills are going to impact inflation going forward. They talked about national insurance. So national insurance went up on the employer. So that means that each employer that employs someone, their national insurance contribution, the part that they pay on behalf of the employee, increased in April. That means businesses are going to have to put their costs up a little bit or make less profit. And let's face it, it's tough to make any profit for a lot of businesses at the moment. So the expectation is that the increase in national insurance is going to increase costs with certain businesses. Now, they also talked about there's a weaker demand in the economy, so we are already buying less. And on average, people have 10% of their annual income saved, but that's creeping up to 10.5%. And that was talked about a bit in the meeting. And that means that they feel that people are saving for a rainy day. They're not buying so much. They're worried about what's going to happen with the economy. And that's because there's a lot of talk about potentially recessions, global trade war is still raging, and people are getting prepared for that. And that's going to slow down the economy. Now, the economy, the GDP, what do they think is going to happen this year? They think that we're going to grow by 1.5%. So not a recession in their eyes. That could change. But they believe that we're going to grow by 1.5%, which isn't very strong. Next year, they think it's going to be even worse. They think we're going to only grow by 1%, which is mental, thinking about all these crazy few years. Since 2020, it's been really tough for a lot of people. We just need to have a bit of growth and feel like we're doing well, but we're not. We're really struggling still at the moment. So GDP isn't going to set the world on fire. They mentioned about housing. So obviously we're a property channel. They feel that housing investment is going to improve. What does that mean? Well, that's talking about the properties that we need built. So Labour have pledged that we would build 1.5 million properties. They think this rate cut will get some developers starting to build, starting to get projects started. And they feel that the forecast with rates going down will mean that some developers will start to get those projects moving, because a lot of them are just sitting there at the moment. Just down the road in Dorking, there's a proposal to build 400 properties that is just paused at the moment. Nothing's happening. The site is just empty. And so a lot of that could be down to the fact that rates are low. That means borrowing for them is rates are higher. Borrowing for them is more expensive. And also, if they complete the project, they want rates to be lower and the economy to be good in order to sell them quickly. So they feel lowering rates is going to stimulate some sort of housing investment. Wage growth, they talked about that. This one annoys me because every month every time they meet, they talk about, they worry about people getting pay rises that are too large, because that would mean people spend, and that could keep inflation roaring along a little bit. But the wage growth they feel is going to slow down. Currently, it's 5.6% wage growth on an annual basis. They feel that's going to slow to 4%, but that's still improving people's affordability. So that's higher than inflation. So over time, people are going to get that little bit more wealthy, which is good. How long is this inflation going to stay high? They feel another 2 years of high inflation, and we will take 2 years in order to get back to that 2% target, which isn't great. Tariffs, that came up a lot. So tariffs was talked about by a lot of journalists here. Everyone wants to know the Bank of England's thoughts on the UK trade deal, which is getting announced today, or maybe is announced by the time you watch this. The Bank of England were adamant they had no idea what is in that trade deal because they did their meeting on the rates yesterday. So they felt that, or they kept saying they don't know what's in that deal, and that didn't impact the rate cut decision today. But what they did say, Andrew Bailey did say over and over and over, he thinks that a trade deal with America is very, very positive for the UK. But he emphasised that it still might not impact our GDP and our economy too much, because what we need to happen is all countries to get a trade deal, because we sell our products to other countries. If their economy shrinks due to the fact that they don't have a trade deal, that still could slow down the global economy. When they talked about the risk of deflation, that's something that they talked about as well. And they said there's a real risk of that, because if America isn't trading with USA, which effectively they're not at the moment, because you've got tariffs of 145% on goods that ship from China to America, meaning that cost just means people aren't buying that stuff at the moment, then China could dump that product on Europe, on Africa, and other regions around Asia as well, at a really cheap price, causing deflation. And that is something that the bank worries about as well. Deflation isn't good because it would mean a lot of unemployment could happen in the UK. So look, all in all, this is a good meeting. It's positive. We're moved in the right direction. The only people that really aren't going to do great out of this is savers. Savers are going to get less return on their savings for sure. That's not great. But this could get the housing market moving along a little bit faster. The fact that we're expecting more rate cuts, and that's what was implied as well here in this meeting, that's good. What that could do, and we want to keep an eye on that, and we'll see how that happens in the next few weeks, is that could reduce the swap rate. So the swap rate is the rate that your bank borrows from. So NatWest, HSBC, they go to bigger lenders. They borrow on something called the SONIA swap rate, and that currently sits at 3.5%. And that means that they can borrow at 3.5%, which is why they can do deals like 3.79% with you. That's why that works. And so if that drops, and that's based off expectations on where the Bank of England are going to end up with rates, that means that we could get some more mortgage rate cuts over the next few weeks and months. So that's what we've got to keep an eye on. Are we going to get more mortgage rate cuts? Potentially, and that's a good thing. So do let me know in the comments, what do you think about this rate cut? Did you think this was what was going to happen? Because not everybody did, for sure, that watched the channel. And do you believe that Barclays are right? I did a video a few days ago, which you can check out by clicking on the Property Accelerator logo. Look on videos, look at the video, talked about 4 rate cuts expected. What Barclays are saying is they feel the economy is going to slow down faster, and they think the Bank of England are going to cut in the next 3 meetings. There's 3 more meetings prior to, or including September, and they think we'll be down to 3.5% by then. Do you think that's possible? Let me know in the comments. Do smash like, do subscribe, share the video with someone that owns a property or needs to know what's going on. And also check out all the other content on the channel as well, including this video right here.